Adam, we'll get to sort of some of your themes on the long side, but let's just talk macro for a second. You heard Bullard, I assume. He's also talking 100 basis points by July. Is the market overreacting, in your opinion, to sort of what we're hearing from the Fed?
Look, I mean, there was a pretty big shift in the perception about interest rates, and we follow more the Fed fund futures than we do the 2- and 10-year yields because they've moved much more dramatically. And I think that got a little bit extreme. I mean, when you see the big banks saying 7 hikes this year, I think that's too hawkish. I think that it'll be less than that. So we'll see what's baked in the market. My guess is that we'll have a choppy month or two. And then, as Steve just said, history shows that usually when you raise rates, it's because the economy's good. And when the economy's good, corporate earnings are good. So I'm pretty bullish on U.S. equities in any medium to long-term view because I think corporate earnings will probably grow.
Yeah. All right. So what equities in particular? Obviously, anybody who's followed the market over the last month knows that high multiple technology names with perhaps high revenue growth but not a lot of profits have gotten crushed. Do you like them or do you go to a different spot?
Well, we had a good call to be underweight that stuff in the fall. And then 2 weeks ago, Friday the 28th, we upgraded from underweight to equal weight, kind of saying it's time to start adding or covering some of the shorts in growth. When I think about the growthier side of the market, I think the thing that looks the most oversold is biotech, David. I mean, the multiples are down 50%. The sales outlook is the same. And I think this whole interest rate call on biotech probably is overblown. I don't know if you know this, but only 15% of biotech companies ever generate positive cumulative free cash flow. So this whole notion that, their cash flows is impaired really doesn't apply very much. So I think biotech's probably pretty good risk reward on the more speculative side. And if we get any directionally dovish commentary, relative to what's baked in, maybe that can catch a bid. I like old tech, some of the stuff like Dell, where it seems pretty cheap and expectations are low. So I think there's things you can buy on the tech and growth side for sure in a balanced portfolio.
How focused are you on the geopolitical situation right now with Russia and Ukraine? I mean, it does seem like, at least until Friday, this was something investors in the market was largely shrugging off. But from a military standpoint, from a defense expert standpoint, I mean, folks are pretty worried because Putin has been moving those military units and troops from the west side to the east side, which is seen as a major strategic shift. You have significant firepower, more than exercises would suggest. And then, of course, you've got diplomats and Ukrainians leaving the country. If we were to actually see an invasion, does that ripple through the markets in a meaningful way?
Look, I mean, as a human being, obviously, I'm worried about it. I spent a lot of time, reading and thinking about it. This has been going on for several months, the buildup. So I think in terms of the market reaction, it's always hard to gauge. When you look back at sort of a basket of these events historically, it tends to cause some short-term risk-off behavior, followed by, resuming, sort of the prior trend. So, obviously from the human perspective, it's quite worrisome. But from the market perspective, I'm not sure how much it really impacts corporate earnings for Microsoft or Apple or the larger companies that have pricing power. And I think when you take a step back and say what's happened here in the last few months, in my mind, what happened is perception of rates changed and it morphed into a growth scare. Now you're throwing a little bit of fuel on this with this geopolitical tension. But when I kind of take a step back, do I think 2022 earnings are going to be above 21 earnings? Yes, I do. And do I think 23 earnings are above 22? I think so. That's my base case, unless we get a tremendous amount of Fed action and they purposely cause a recession to cool inflation. So I think there's still the bias is toward being, buying on dips, Morgan, when you see this kind of risk take hold.
So you mentioned mid-cap biotech. You mentioned some of the quote-unquote old tech. What do you steer clear of in this market?
I still think that profitless stuff, like the profitless software, is tricky. We've been sort of cautious on that. I think a lot of these staples are really over-earning and are expensive. So we're trying to avoid the staples that trade at 20, 25, 30 times 2022 cash flow, maybe benefited from COVID. There's a lot of, quote, work-from-home names. I know you and I chatted right before Peloton's earnings that I was kind of cautious on that type of stock. Zoom, DocuSign, things that over-earned during COVID. And I think that basket probably still is worth avoiding. So I think there's a number of things to be cautious on. Industrials, unless they have a pricing power algorithm, which some of the quality ones do, other ones have really high estimates. And if industrial activity is plateauing some, that could be worrisome. So it's a balanced portfolio. Look, backing up, our top picks has been energy and materials all last year, all this year. That remains the case as I continue to think that demand supply dynamics are such that oil prices can go higher and those companies make more money. So there's lots of things to buy and sell. But our top choices are energy and materials, and then we're taking shots now at some of the growthier stuff that's oversold: biotech, healthcare services, old tech, etc.
Shepard Smith here. Thanks for watching CNBC on YouTube.